Ashwini Agarwal, co-founder and partner of Ashmore Investment Management India LLP, joins in on the show right now. Ashwini, hi, good morning. Last two trading sessions, Ashwini, somewhat of a respite, if I can call it, in the backdrop of what Monday was, not just for India, but across the globe. But I think all of it rests on tonight when the FOMC is going to announce its outcome. Do you think with Monday's crash, markets have priced in a 75 bips cut or hike?
So good morning. Great question to start the conversation, obviously. The 75 basis points hike is being spoken about very widely, and therefore it is reasonable to assume that it's significantly in the price. The question to my mind is not what happens tonight. You might see a relief rally tomorrow or something along those lines. That's a very, very short-term trend. But I'm going back to what Nikunj was saying earlier in the show, that what happens as an aftermath of this rate increase, and is this the end? So those two questions, I think, are more worrying to my mind, because inflation is trending much higher than what we had anticipated. The energy prices are not showing any signs of cooling off. And in this kind of a narrative where you have fiscal incentives having been withdrawn and you have higher rates coming through, there is obviously a significant slowdown up ahead. Compounded with this is the fact that investors across the world have lost a reasonable amount of money, both in the markets as well as in cryptocurrencies. And the negative wealth effect of that is still not fully understood, still not fully priced in. So I think you might get a sort of a trading rally because sell the rumor, buy the news type of thing. But I think on a global market basis, I don't think we are out of the storm yet.
We can endlessly argue about this is wrong, this will go wrong, this has gone wrong. What should one do? The list of negatives is a long one.
Yeah.
And if I'll give you 4, you'll give me another 4. And then Aisha will give us another 4. Then Avan will send me a WhatsApp with another 4. My question is, what is the good news here?
Okay. The good news is that India is in a reasonably good space when you look at the rest of the world. Okay. And I say this, because our macro imbalances are limited. Leverage in households, leverage in consumers is relatively small. Your lending infrastructure is in great health. The PLI schemes launched by the government of India do seem to be taking some effect. If you look at the order books of various engineering companies, you look at the investment plans that are being announced every day. So investment is going on in full swing. It is possible that after whatever 7% odd growth in real terms in fiscal 23, most of which is going to be front loaded, you might see slower growth continue through in fiscal 24, which is say 5% or 5.5%, something along those lines. But it would still be a reasonable growth in context with the rest of the world, which is actually in a pretty bad shape. So to my mind, I think, that's what excites me. What excites me is that we've gone through almost 6 or 7 years in doldrums. You had demonetization, you had GST, you had the financial crisis, and then you had COVID. And now I think the deck seemed to be clear for a reasonable pickup in growth. Obviously, the headwind now is from the global markets, not from local issues. So to that extent, you will lose some growth because as the external sector is weak, you will lose some growth on account of that. But even then, I think for long-term investors, the coming storm or the current storm is a great time to be doing long-term investing. I think one has to find one's ideas and keep sort of adding to them gradually as we go along. We don't know when markets will bottom, how deep they will go. But I think the fundamentals of the Indian economy relative to the rest of the world are in very good shape. So that's the positive news.
Okay. I'm just going to look at the 1-year chart, and this is a point which I just want to bring out for our viewers, that In last 1 year, the returns have become flat to negative. That's the intraday graph. This is the YTD graph. But if you look at the 1 year, which is where we've captured a bit of a euphoria, listings of tech companies, more like a retail participation. In last 1 year, markets have not given you any return. Now, another 3-4 months, and if earnings continue to grow, that means markets suddenly will become attractive. And that is the point I think we need to really focus on. What has happened cannot be changed, but what will happen versus where the prices are, that is what really needs to be understood. There you go. This is a line, this graphic for me is the eternal truth. In last 1 year, markets have not given any return. So Ashwini, how are you picking your spots?
So, financials continue to be an area of great interest to us. I mean, some of the stocks have done well, others have not done well, but the financial system is in great health. Loan growth is picking up. If you look at the RBI data ended 20th May, loan growth for the banking system is about 12%. Obviously, some of it is driven by inflation, but the fact is that rising rate environment in the short run for banks that don't have a lot of long-dated government bonds are positive on spreads, and you are seeing loan books grow as well. So you've got both volume and price growth coming through. Credit costs continue to be under control. So I think the earnings narrative for financial remains quite strong. Automobiles is another area that looks interesting to us. Again, you've gone through about 5 years of growth, which is simply not there. In two-wheelers, it's negative. In cars, it's flat to down. Trucks, flat to down. And I think, going back to my comment that if investments in the economy are going to take place and a lot of the replacement demand that got deferred due to COVID is going to come back, maybe some of it will come back, some of it will get deferred yet because inflation will start to bite the middle income households. So that might happen, but still you should start to see growth in both volumes and the cost pressures should start to go away. We are also looking at industrials selectively, trying to figure out how to play the capex cycle. I was a little circumspect about this 3-4 months ago, but now as more data is emerging, I'm gaining more confidence in that theme. So that's another area we're looking at. You will note that most of the sectors I'm pointing out are India specific. So I'm looking less for businesses outside India or outward facing businesses. I'm more looking at businesses which are inward facing, local economy oriented.
Good morning, this is Nantara joining in. So just going forward with that, if you're looking at more India-focused businesses, where would that leave the IT pack, which has, of course, been an outperformer? We've seen a big correction as well. Many think that maybe there's a decent entry point in some of at least the top-tier companies. Where would that leave the IT pack for you?
So, I've commented on this in the past as well. IT is in a situation where growth outlook has been very robust, but valuations have been very extended. And now, up until very recently, one was not getting worried about growth, but with the kind of storm that seems to be coming on the horizon in the United States, my sense is that give it some time and the growth outlook may start to look a little more difficult. Counterbalancing the revenue aspect will be lower pressure for costs as demand for talent also kind of abates a little bit, especially as the startup ecosystem gets starved of liquidity, and the fact that the weaker rupee might provide some tailwind. I still am not very sure how much earnings downgrades we'll see. Probably earnings downgrades may not be there or maybe marginal. But given how well the sector has done, how well owned it is, and where the valuations are with respect to historical averages, I would still tend to not be, very excited about stocks in this area, especially the mid-cap names and the smaller companies, which are very expensive to my mind. Large caps still look okay, relatively speaking, but can you make money on them? It's going to be difficult.
Ashwini, I understand you folks are overweight on financials, but you don't like small banks. What's the rationale behind that? And when you're overweight on financials, is it once again, for the private sector lenders where it's all seems to be about ICICI these days, HDFC trying to play catch up, or are you preferring public sector banks where SBI, of course, has remained an outperformer?
So, we like all the frontline names, some in public sector, some in private sector. Unfortunately, can't take names. But the argument of big versus small is simply that the smaller banks will find it harder to compete on the liabilities front. Having said that, I'm not sure I've said that we are very against small banks. I don't think that's true. We do have one or two names which in the smaller cap space, which we like, which offer an incredible amount of value. Structurally, of course, they have a disadvantage compared to the larger banks, but if valuations are favorable, then why not? I mean, a rising tide lifts all boats, and therefore smaller banks that have a healthy balance sheet are well provided and are available to you at a bargain basement price should be looked at, is my view. I think longer term, these smaller banks have a challenge. The NBFCs have a challenge because the business is getting consolidated, cost of funding, etc., are challenges. But I wouldn't say that we are against all the small banks.
Particularly, what is it, Ashwini, that you would recommend a sell on or a complete avoid where you believe that fortunes are going to change in this high interest rate scenario?
It's the metal space is one where we've historically stayed away from. And to my mind, destruction of demand globally and, large capex plans going through can make the going a little bit difficult for them. They are deep cyclicals and we are going into a cyclical downturn as an economy. But we've kind of ignored them on the way up and we're ignoring them on the way down. So it's kind of not a very exciting sell for us. We didn't own them, so how do we sell them? That's the question. So that's one place that we've tended to keep out of. I'm also concerned about very high valuation companies. Which have still done, which are still expensive relative to the rest of the market, despite the rout that you've seen in these stock prices over the last 6 months. And we are value investors. We find it hard to pay 50, 70x, 100x on earnings, notwithstanding the growth. So that's one area where I will continue to stay away from. I also think that the funding environment is going to get a lot more selective as we go ahead. So unless you're on a path to profitability and you're making money, I think valuations will see a compression across the board. And the richer you are on valuations, the harder it's going to be. So that's a broad outlook that I have on areas where we are not very gung-ho about.
Right. Okay, Ashwini, good to have you on the show.
Thank you
so
so
the
much.
famous adage, of course, is sell in May and go away, but we should continue for June also.
Thank you.